Thanks for joining us on this episode of BayBridge Real Estate Capital Talks. In this series, we interview successful real estate insiders to get their perspectives on different sectors of the industry, all with a financial focus. Our firm helps bring institutional capital to the real estate markets across the United States. Sector expertise is important to our success and yours. Today, we're talking to Evan Weiss, COO and founder of LWHA Hospitality Advisors. Let's start off by covering LWHA and what your company does, Evan.
So LW Hospitality Advisors, I speak fairly quickly as I'm a native New Yorker, as you know. If we need to, we can repeat anything we need. But LWHA is about 9.5 years old. I'm one of the co-founders along with Dan Lesser. We have another partner, Gary Eisenberg, on our asset management side. Essentially, LWHA is a real estate services firm, but focused exclusively and solely on the hospitality and gaming spaces. We're a national firm. We've done work in all 50 states, Canada, Puerto Rico, Caribbean, Mexico, and a little bit of work in the UK as well. So actually, we're somewhat international as well. But most of our work is done here in the 50 states. And our business is separated into three primary categories. Primary category number one would be valuation, appraisal, feasibility studies, market studies, litigation support, expert testimony. Again, only hospitality and gaming, and mostly valuation and operational matters. The second vertical is third-party asset management, consulting advisory, help folks find brand management companies and do true third-party asset management, receivership work as well during these wonderful COVID times. And then the third vertical, which is actually a firm we just launched in January with a partner named Ryan Melliker. That firm essentially is a predictive analytics research and consulting firm. And we just launched our Q2 reports literally this week, I believe yesterday as well. So fairly new company, but we're looking forward to the successes there that we've experienced in our first two platforms.
That's awesome. Besides doing this on Zoom from being at home, where's your business shifted post-COVID, and where are you guys active now versus, January, February?
Yeah, it's a really good question. Frankly, our business does well fortunate in the good times, and our business does well, thankfully, in the bad times. It's the frozen times in the middle that are really the most challenging. In the good times, we're doing appraisals for refinancings, portfolios, mergers and acquisitions. We're doing market studies and feasibility studies for all sorts of new projects, mixed use, single asset, and everything from, a Holiday Inn Express on the one hand to a full service, 2 million square foot resort on 80 acres in places like Florida, Hawaii, et cetera. And asset management as well is sort of during the January, February, and pre-COVID, during the good times, again, folks looking to get better profit margins, folks looking to develop hotels. We kind of handhold them. We become their de facto hotel partner, and really help folks concept through a number of different things. We do PIP reviews. We do, a lot of consulting advisory for folks that know and understand real estate and their geography, but just miss the hotel component, and they bring us in to introduce that expertise. So the shift within the valuation space is now obviously we're targeting special servicers, we're targeting the lenders that we've done appraisals for that need reappraisals, collateral management appraisals for private debt platforms, and assisting in the process as special servicers and lenders begin to start working out, balance sheet lenders, private debt platforms, as they begin to work out their loans, their assets, to see who has equity, who doesn't, what makes sense, where valuations are. Frankly, it's a lot more difficult than in the good times. The good times is, you've got a plethora of information, you've got just transactions, you have just a significant amount of data in the market by which to pinpoint your answers and your thought processes. Now, it's conversations like this with really successful, smart people like yourself on the capital market side that are aiding in what we're doing. And on the asset management side, like I said, we've kind of shifted a little bit more towards receivership and a little bit more arbitrage on the asset management side, where in triage, where we're helping folks understand which assets make the most sense for them. Oddly enough, we're still doing some consulting on new constructions. I was just on the phone with one of our clients yesterday who is in the process of developing a plus or minus 1,000 room convention center here in the United States, convention center hotel that is. And the brands are actually more active than ever in terms of pursuing those deals because they know that going forward, there will be fewer and fewer of those newer deals. So much of the same, just shifting to a different clientele, really. And again, I'd say our job is harder, is more challenging today than it was 6 months ago or even 3 months ago.
Sure. Have you seen the special servicer work really start to happen yet, or are we still in the calm before the storm with all of that kind of issues that are going on there with CMBS?
Definitely calm before the storm. I think you're spot on with that comment. We are seeing some trickling in. We all know the major servicers, whether it's Midland, Trimont, C3, L&R, Torchlight, Argentic just opened up its own servicing platform, 3650 Reed on the West Coast, and out of Florida opened up their own servicing platform. So we're seeing onesie, twosie, Rialto, of course, as well. Apologies for not mentioning them earlier. But we're seeing onesie, twosie sort of opportunities, if you will, or issues that are starting to bubble up. But as we all know, really many borrowers made their payments in March on the hotel side. Many missed in April and many more missed in May, right? I don't know the exact percentages. I don't think obviously TREP has the actual numbers on all that. But at this point, May was a significant miss, and so is April. So if you think about it, April, May, June, a lot of these servicers are negotiating 90-day, 120-day, in some cases even 6 to 12-month forbearances. And so if they're doing that, what they're trying to do is they're obviously trying to triage and trying to make sure that, again, this borrower has money. Let's either do a work out there and sort of move them along. And if they don't have money, let's see if they still have any equity remaining in the deal. They also don't want such a significant volume because this is not just a singular market. It's not just a national, but it's also a global pandemic. This has affected pretty much every hotel in the country. Some are obviously faring differently. We can talk about why and how, but generally speaking, there's pretty massive disruption in the space, and so they're trying their best, in fact, to push off, if you will, and to ensure that they're able to deal with each borrower and each loan in the appropriate fashion. And so we're just not seeing that massive volume yet. I guess back to your original question, long answer, but we're just not seeing that significant volume just yet. We anticipate seeing it probably sometime around August, September. I will tell you that when this started, I told our team that we'll probably start seeing that significant volume around June. Given that June is about 3 days away, I don't think that that's going to happen. Our belief internally and our leadership team is again somewhere in that July, August, probably August, September range. That'll be 90 to 120 after May, the significant amount of misses.
Touched on
debt payments.
Briefly an interesting point. Different types of hotels are faring differently. So kind of two-part question for you. Currently in the pandemic where we are, can you maybe go over some of those, high-level brands, location, types of flags, how they're faring? And then also on the recovery, what do you see is going to be the challenge? Is it going to be, full service hotels versus limited service, developing markets versus kind of gateway markets? If you give a little color on kind of the now and the future, what you think kind of the winners, losers are and where the pain will be, that would be interesting. Sure.
A lot of questions there. So the now, it's interesting. The lower tier brand families are faring much better. Extended stay hotels as a segment of the population are doing much better. We're seeing a lot of first responders, National Guard, FEMA, different types of national agencies are all being put up at extended stay hotels. They have kitchenettes or full kitchens, and they're just much more conducive for that. They also tend to have more space per room and some level of a grounds. And so they are faring fairly well, both in urban and mostly actually in suburban marketplaces. The lower tier brands are also doing better. Choice and Wyndham, if you look at their stocks and if you look at the equity research analysts, how the sales side analysts are looking at those particular companies, they're very bullish on them. Wyndham, I think, was the top pick of one of the analysts I read yesterday. I would say that that's not typical, and that was not that way pre-COVID. You look more at the Marriotts and the Hiltons and the Hyatts and the IHGs, which, by the way, are considered to be fairly intact. I mean, Marriott had a bit of a liquidity issue at one point, from a corporate perspective, because if you think about it, where's most of their revenue from? From fees. How do you collect fees? On revenues. If there's no revenues, there's no fees, and they have a tremendous liquidity issue. But I believe Marriott has over $4 billion in liquidity. I believe Hilton's over $3, maybe over $4 billion as well in liquidity. So they're both staffed up fairly well on the C Corp side. And again, the Choice Wyndham products are actually doing fairly well right now. So again, extended stay and the lower tier products. There was a point, and I believe it's still ongoing, that the economy segment of within STR, within Smith Travel Research's segmented RevPAR, revenue per available room, within the different segments of the hospitality business. Economy, which is the lowest, had a higher RevPAR, higher revenue per available room than luxury. And it was like that for at least 3-4 weeks in a row. And I think it's still like that because luxuries had a $295 ADR, but a 5% occupancy. Whereas on the economy side, they had, a 30% occupancy at a $40, $50 average rate. And so when you do the math, the RevPARs were greater. And that just showed you that it just showed you, don't look at stats right now. It doesn't matter. The world is upside down. It's somewhat irrelevant. And you really have to be careful as to what conclusions, if any, you can draw from the current data. I would also say that the data right now is somewhat, even according to STR's own admission, is somewhat in flux because some hotels are closed and many of them are still closed. And if a hotel is closed a certain number of weeks, I believe it's 4 weeks consecutively, it's taken out of the numbers. So as we're seeing occupancy rates tick upwards, I think that nationally we've seen an uptick of, the negative RevPAR has gone from a low of 83.6. I think this past week it was in the high 60s, low 70s in terms of, actually the numbers I believe come out today. I think last week it was in the low 70s from a decline in occupancy week over week, which is still horrific, but it was better. But a lot of that could be due to hotels going out of supply in their official numbers. So again, let's be careful how we look at those figures. So I think the challenge going forward in terms of the recovery is definitely on the full service hotels. Urban markets, I think, are going to be challenging to return. It's interesting, it's sort of a push and pull. I said in an article, in a quote that this is a lot less about the hospitality and the real estate businesses and a lot more about psychology and sociology, both of which I know nothing about and barely can spell. But if you think about what's happening right now, this is not 0809 where we're in a recession. We are in a recession. It could be a depression, God forbid, but we're in a recession. There's 40 million unemployed as of this morning. I'm sure you saw the numbers. We're probably going to hit a 20% unemployment rate, which is just such a disaster. On the good side, we only had 2.2 million new jobless claims, which is still horrendous, but down. I mean, I think we're pretty much at the bottom, it seems to be, according to most economists. And GDP fell, I believe, in Q2 by 5%, or Q1 rather by 5%. It was expected to fall by 4.8%. Again, all those metrics are negative. And so when you look at where the challenge of the recovery is, I think many of those suburban markets and the limited service hotels that have very much tighter operating models and much lower staffing models, and probably even will probably even morph into even lower staffing. If you had, let's say 100-room Hampton Inn, I'm just throwing out different brands. It could be any sort of limited service, upper mid-scale brand, if you will. Any of them, let's say on average 20, what they call FTEs, full-time employees, that may go down to 15 with technology and with service and the way that they're able to utilize different technology and cleaning programs. So it'll be really interesting to see if there's a net negative sort of return to hospitality employment at some point.
Well, thank you, Evan, for joining us today. To our viewers, I hope you found this episode interesting and insightful. If we can help you access capital for your projects, please reach out to us through the information on your screen. See you next time.